Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer and today we're going to be taking a look at Eaton stock. This one came in by request down in the comment section of one of my other videos. If you have a stock request you would like me to take a look at on the channel, just put it down in the comments. I'll get it on the whiteboard behind me back there and eventually I'll make a video. If it's a stock that's in the S&P 500, I usually post those here on YouTube for free and the rest I post over on Patreon. And I'll have those links down in the description. If you do join the $5 tier at Patreon, you can also get a big discount to the full Cyclical Investors Club service over on Seeking Alpha, where I've been writing since 2015. So I guess this is my 9th year now doing this. As always, this is not individual investing advice. This is just how I analyze stocks. Okay, Eaton. So I've tracked Eaton for a long time. Because it is what I would consider a high quality, deep cyclical business. So how do I determine that? Well, the high quality part comes because if we go back 20 years, we can see this dark green shaded area here on the fast graph are earnings per share. And you can see that over time, there's been a pretty steady rise all the way during the past 20 years with a couple interruptions that happened during recessions or directly. The earnings were affected directly after the recession. The one in 2009 and the one in 2020 where earnings fell down, but they quickly recovered and then the business kept going, kept growing. So that's what we want to see. Now the threshold that I use, that's what we want to see to determine whether a business is high quality. I really want to see earnings growing faster than inflation. That's the basic standard. And so these guys meet that. Now, if we go back in time to determine whether the business is cyclical or not, what I look at are these drawdowns here in earnings. So if this is more than 50% and it recovers and it's not just, a business that's on the decline, then to me that's a deep cyclical business. And usually, and if the stock price also falls a lot, so I'm just going to pick a couple points here. Close to the top and close to the bottom, about 70%. So the market fell like, I think the S&P 500 fell like 55%. These guys fell 70. So the stock price fell more than earnings actually fell. So the stock price is also deeply cyclical because it fell deeply and it recovered. So it only took a couple years for it to recover from that decline. The entire period only took about 3 or 4 years. Usually I want that to be under 5 years, and it is. And earnings, the entire period that it was down was only 3 years. We want that to be under 5 years usually, and it was. So that all looks good. If we go to today, so the COVID decline was pretty quick and not as deep. But you can imagine that if that turned into like a deeper, longer recession, we probably would have seen a similar type of earnings decline. And then the stock price, I believe, fell about 45% on these particular, this doesn't go on daily, but about 40% on the fast graph. I think in my notes it went down like in between 40 and 45%. Which is, again, deeper than the market. I think the market was only like 30% or something like that. So it looks as though it's still behaving just like it had behaved in the past when there's a recession. Now, a couple things I find interesting. I really think there's like 2 types of investment philosophies that one can have when they go to purchase a stock like this. Or maybe 3. One is my philosophy, which I want to try to buy these at the bottom. I want to try to buy them down here and then hold them, and usually until they recover. So for a couple hundred percent return, that would be what I would be aiming for with a business like this and a stock like this. Whereas others might, especially during this particular time right now, where now this exaggerates a little bit because it's such a long time frame, but on the fast graph we can shorten the time frame. I do have a 25% off affiliate link for fast graph down in the description too, if anybody's interested in, if you think this might be useful for you. So right now with this let's see, let's go from the peak before COVID to the price now. So we've had a 200% run off the peak before COVID. So this is, I think, mostly demand combined with some speculation and momentum from like AI, data centers, and things like that, creating more demand for these. This is electrical component company. There are a few other electrical component companies I've seen that have had this same type of pattern where the past couple years, basically since the AI kind of craze took off or excitement, the stocks have kind of rocketed higher. So I'm the type of investor that's going to want to buy toward the bottom of one of these, but there are other investors who will buy when the momentum is quite strong, especially if the fundamentals are quite strong too, and just moving in the right direction, basically. It's not a valuation thing necessarily. They just want to see kind of earnings moving in the right direction. They want to see the stock continue to move in the right direction, and they'll invest or trade. Usually it's more of a trade until this reverses, and then they'll try to sell before they get back down to wherever they bought it from. So that's one type of way that people can invest. And that can go along with the theme of like the AI demand and everything too. So there's some fundamental analysis behind it, but nobody's really, I don't think, well, I shouldn't say nobody is running the numbers, but I mean, let's just say they're more optimistic than I would be when it comes to actually crunching the numbers on this. Because if you look, I mean, earnings are expected to grow, we'll call it mid-teens, low to mid-teens from analysts over the next couple of years. And it trades at a 35 PE. So even if it traded at, even if they were growing earnings at 20% on an earnings basis, this would still be pretty pricey to me. And it would be, and that's assuming that it can grow earnings at 20% for a decade, right? So I think, maybe down here when it was like 22, they grew the previous year 20%. And then if a person said, hey, if they can keep growing well, that could be a good deal, right? If they think it's going to be like a secular. So like down here at, let's call it $200 a share, I think a person could have made a valuation case if they thought that secular trend was going to be in place. Up here, this is mostly feels more like people trading like the momentum, trading the story, basically, rather than actually kind of putting these numbers together. And I think that can be risky with a business that we know can be cyclical at times. So my approach is always just to buy at the bottom, and if I miss out on something like this, then so be it. But I think what could happen for someone like myself is we could have a disappointing year or something like that, where the market just gets way ahead of itself. Maybe there's kind of a recession, or just the expansion and demand for this. If we just take this particular company in general, the demand isn't quite there, and it kind of reverses for a year. Then you could see the stock price drop a lot, and that would be where I would probably be the person that would come in and try to buy it and try to put in kind of a bottom, because maybe that underlying secular growth is still there, but it's just not as stable, not as steady, not as perfect as everybody, and not worth as much as everybody thought, right? So my strategy, which I call my deep cyclical strategy, and again, I've tracked Eaton for a long time, even though I haven't bought it. What it does is it looks at previous down cycles. Once it's established that it's a deep cyclical business, it looks at previous down cycles of the stock price. And if I could get my page to load here, I can get it up here. All right. Because earnings fluctuate so much, it's really hard to use an earnings-based analysis. So I like to look at the previous drawdowns that the stock price has had and use that as my guide for a deep cyclical. You can see I have it labeled as a deep cyclical. And so I'll go back and look at the previous drawdown periods. So I don't know if these are exact or just rough. So 2001 wasn't super deep. It was only 40% from peak to trough. But 2008 was that 70% one that I showed you earlier. And then 2020 was 45%, even though that was a very short decline. So I look back at these and I say, okay, where would I want to try to buy during like a recession or a real downturn? And I chose to come in at about 65% off the high. Right now, the stock just made new highs at 338.88. So it's probably going to be about 65% lower than where now this will go up as the stock price rises, but like, 119, 120 is kind of right where I'm at now for a buy price. And you might think, well, what are the chances that this will ever trade down that low? It's traded down that low in the past, and it can trade down that low again. Will it? I don't know, but I track a lot of stocks so that if it does, I'll be ready. And if you look at, I just bought an industrial. I'm not going to talk about it because it's not in the SP 500 and it's in the full service, but I just bought an industrial stock a couple weeks ago that fell this far, almost exactly this far, 60 or 65%. And I had owned it before. I think if we look at, not sure what I want to look at actually. Yeah, let's look at one that I've talked about, like Whirlpool. Now this is different. These guys are making like appliances and stuff. But if I went back to 2021 and I said, yeah, I'll buy it when it's like 65% off its highs or whatever. I don't know if that's what my actual number is, by the way, but and it's almost there now. It's probably really 70% because I haven't bought this one yet. But if I said, yeah, when it gets 70% cheaper, that's when I would consider buying. Everybody would have said, well, you're crazy. You'll never get that low. And remember, everybody that had bought the stock basically, even if they didn't buy it during the COVID decline, if they bought it back here, at that point, they were up 140%. They would all said I was crazy. It would never fall back down. But it has, because it's a cyclical business. And you can look back and you see, now this is deeper and not as high quality as Eaton is, but you see the same pattern where earnings fell back in 2008 and 9, and it fell about 50% over the course of 2 years, and then they recovered, and it was a little kind of a choppier recovery, but then they recovered. So, and if you went back here, probably they fell 70 or 80% or something like that, right? So they fell 82%. At least that's probably more like an 85% decline. So again, and they're almost back down there again. So it does happen, I guess, is the point that I'm trying to make. And kind of that 118, 119, 120 is what I'd be looking at for Eaton using my approach. Now, my approach is not the only one. I think if a person thinks this momentum can keep carrying on, or if the secular growth trend is going to really be like 20% a year for the next like decade or something like that, then maybe they can make those numbers work. But that's just not that's not what I try to do, because the downside is really tricky. It can be really deep, one, and it can be really hard to predict when it happens. The market will usually send a stock price lower before the earnings actually fall lower. So if you go back, and I'll just use Whirlpool as an example. So the stock price peaked in mid 2007. Earnings didn't start falling until the next year. So if you waited until then to sell, you already would have lost like half your money, right? We can actually let's look at Eaton. I don't know if it's going to be the same with them, but so yeah, earnings up here are, when they hit their peak earnings, the stock price was down like massively. And so you're not going to get a earnings warning. It's down 60% before. And this is when they went into this decline at a 15 PE. Now they're at a 35 PE. So if they experienced an earnings decline like this again, if there was a bad recession or something, you're looking at like 80%, 90% declines in the stock price. That's the danger that's always out there. And it will start with no warning. So you'll be down 50% before you even know it. And that's why I don't like to sit on the edge of my seat, I'd rather much, trying to figure out where the top is. I would rather buy at the bottom and then or buy somewhere farther off the highs and then wait. And, there can be big shakeouts like this one here on the way up where it falls 20% in like a couple months. And I guarantee you a lot of people probably sold out right here, and then the stock price took right back off. So you can't really predict, or if you had a trailing stop or something on, it probably would have got triggered here and pushed you out of the stock. And so it's just really hard. I think it's really hard to try to time these, figure out where the tops are, squeeze every last bit of the juice kind of out of the lemon, and then get out in time before it crashes. So that's why I try to buy at the bottom. All right, hopefully you found this useful. If you did, hit the subscribe button and the like button. If you have a request, drop it in the comments and I'll get it on my list, and eventually I make a video. Thanks everybody. Later.